Good afternoon. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay and Pavitra Parekh is also here with me. Ladies, pretty good, right? Holding above 17,700 this morning. It's a promising Tuesday morning. The benchmark indices are up close to about 0.5%. In the last 30 minutes, we've come off a tad bit from the high. The high today was about 17,750. So from that level, we've given up about 30 odd points, but we're still holding up above yesterday's intraday high, which is just shy of that 17,700 mark. Asian markets are holding firm with gains of more than 1% in markets like the Japanese markets and the Korean markets. They're up close to about 1.5%. Some events to watch. Financial Nifty expiries today. IMD is holding a press conference at 12:30 p.m. where they will give you the long-term forecast, the range. Yesterday, remember, SkyMed, the private agency, had said that we are going to be seeing below average monsoon, 94% of the LPA, long period average. Today, let's wait by to see what the IMD has to say. And Delta Corp will be reporting numbers. Small company, but I think the impact of the recent online gaming regulations will be tracked very closely. Sectorally, banks are outperforming. So the Nifty Bank is up nearly 500 points. Real estate continues with its outperformance. IT is the only sore point. So the IT index, if you pull that up, is just down close to about 0.25%. Hi.
Hi. Well, not bad. The 3 trading sessions that I was away, you all have managed to take the market from 1,700 to at least 17,700. So it's not a bad move, right? Though it's been about 2% or so thereabouts, but I think the bulls will take this with both hands. What's interesting is that now the market is running into a small little congestion zone. So I went back and started looking at the levels. Just to recap things, the Nifty is trading above the 20 DMA, it's trading above the 50 DMA, the 200 DMA. It's not yet taken out the 100 DMA, which comes in a little higher at 17,800 plus. So let's leave out the 100 DMA for a bit. There is a congestion zone, as I mentioned, around 17,760 to about 17,800. That is a zone from where we had turned and the down move started a month ago. So let's see if the bulls can really take that out with momentum. What's working for the market is banks, and the bank Nifty is showing a lot of momentum. All the quarterly updates that we've seen from a lot of the lenders, even the NBFCs, they've been more positive than negative. And that's working in Bank Nifty's favor. Obviously, there's Kotak adding to the weight today. The Bank Nifty's 100 DMA is at 41,729. So the Bank Nifty will take aim at that level. It's also trading above the 20 DMA, the 200 DMA and the 50 DMA. That's the next level to watch. In April so far, the Nifty is up about 2.2%. The Bank Nifty is up about 1.7%. So maybe there's a little bit of a catch-up that's playing out at least today. And let's see if that can continue. And that obviously works well for the Nifty. So let's pull up the Bank Nifty contribution list. As I said, Kotak Mahindra Bank, and we'll discuss that stock in more detail because of hopes of more FPI flows coming in. That stocks, of course, are taking things higher, but it has company. The big boys are really lined up quite well. It's only Axis which is on the downside. So, Pavitra, at least banks are really, helping the bulls case. But it's not just banks, right? We have a couple of other movers as well. Overall, it's not a bad market at all.
Not at all. I mean, I think, like Reema was pointing out, IT is under pressure, but apart from that, it's looking quite all right. And also the mid caps and small caps are pretty much in line, right? So if you take a look at it, in fact, for this entire week, we have seen good participation come through from the broader market. The advanced client also looking quite good at around 3:1. So that is holding up well. In addition to banks that we were mentioning, the real estate stocks are really doing well. And this is not just today. This is ever since the RBI policy came through. Of course, rate sensitive, sector. But for this week alone, it's up over 5%. This month, it's seen a 10% up move already. Let's bring a few of those stocks up for you so you can see the kinds of flows, kinds of move coming through in all of these. By the way, also the Q4 updates are coming in on all of these. So it's looking quite good across the board. They're surpassing their guidance and pretty much record sales coming through. This is the 5-day move that you've seen for a lot of these. Godrej Properties up over 18%. So this sector is definitely in focus, and that's what's happening with the market. We'll keep coming back to this, but first up, let's start off with the big stock of the day. That is Kotak Mahindra Bank. It is the top gainer on the Nifty this morning as well. Now, IIFL expects MSCI to increase weightage for the lender in its May review. This is in line with higher FPI headroom. So Vivek is joining us in the studio to take us through the details there. Vivek?
Well, thank you so much for that. So what's actually happened is that last evening, Kotak Mahindra Bank updated their latest shareholding pattern to the exchanges, and as per the analysis, that's been done by quant analysts, the foreign headroom available in this particular stock is now about 25%. Now, which basically implies that in passive indices like MSCI and FTSE, and right now we'll be focusing on MSCI, the likelihood of the stock getting a weight up or a weight increase now improves. And IIFL estimates that on the back of this updated shareholding that we are seeing, there could be inflows of close to $750 million. So what it basically implies is that the underperformance of the stock, which has been mainly due to the intensified or intensive FI selling, actually has a silver lining, and now there is a higher headroom for passive indices to enter.
So basically, if the FPI headroom is less than 25%, then the factor which is given by MSCI is 0.5. When the FPI headroom goes above 25%, then MSCI can increase this factor of 0.5 and go up to 1%, right?
Absolutely right. So which implies that, now the weightage of Kotak Mahindra Bank in the MSCI is likely to double, which is why, that you're seeing the flows go up to almost 750 million. It already had flows of, similar quantum in November 2020 when it was first included. But then, there wasn't enough headroom in the stock or FI headroom in the stock to actually go ahead and reach the 25% FPI limit mark. Now, MSCI, as per analysts, IIFL expects this particular development to be a one-time trigger, and they're likely to implement this particular weight increase in the MSCI Global Standard Index, which is the main MSCI index, in a one-time tranche, and expected to happen in the May index review, $750 million inflow, and that's going to be a very big trigger as far as Kotak is concerned.
Okay, all right, Vivek. Thank you for explaining that to us. Now it makes a lot of sense. That's expectations of some serious money coming into Kotak Mahindra Bank that is actually helping the stock move higher. Vivek, just a further point on this. Tell us how exactly is the headroom calculated? I mean, that 25% figure that you mentioned, how is that arrived at?
For Kotak, the available FI limit is 55%. Now, this is what government SEBI has given Kotak, and FIs can invest in Kotak Mahindra Bank up to 55%. After yesterday's latest shareholding pattern, the FPI holding now is 41.22%. So the incremental available foreign headroom has now slightly gone above the 25% mark, 25.02, which is why you're seeing, the increased excitement in the stock today, and which is why you're likely to see the MSCI inflows. Now, why is it that they're saying the MSCI inflows may come in? Because the bank has uploaded the latest shareholding pattern well in time, well prior to, where MSCI starts taking the updated shareholding into account.
So now that we know that there is headroom, MSCI maybe can go ahead and increase the weight. Weight increases, more money comes in.
Absolutely.
Okay.
So it's just to get back to that 25%, FPI headroom is 55 minus the current holding of 41.25. So we have a number of 13.8%, and that you need to divide by 0.55.
Divide by 55.
Yeah, so divided by 55% or
0.55,
0.55, and that's how you get the headroom of 25%. All right, thank you very much, Vivek, for explaining that. In fact, earlier today, we also spoke with Sriram Velayudhan of IIFL Securities. He's the analyst who put out these numbers of $750 million of inflows. Listen in to what he had to tell us.
If one dwells into the MSCI methodology framework, for the stocks that are part of the index, if the room opens about 25%, there is an upward revision in the adjustment factor. So Kotak should see its adjustment factor getting revised upwards from half to 1. So this should translate into an inflow event for Kotak Mahindra Bank in the May 23 QCIR. We extrapolate inflows to the tune of $750 to $800 million, which is almost 7.5 to 8 days ADV.
All right, that is the word coming in from IIFL Securities. But continuing our focus on Kotak Mahindra Bank, Abhishek is also joining us to really explain the key investor concerns here. Abhishek, this is a stock that has underperformed. So take us through what the fundamental triggers from here can really look like for Kotak Mahindra Bank.
So the first concern over here is that the change. So MD change is the concern on investors' mind, given the fact that investors would like an internal candidate, which would mean more continuity. So market investors, let's say, are waiting for outcome of continuity, and they would cheer if an internal candidate is elevated. Now, secondly, on the fundamental side, the general perception is that the cost of funds for Kotak Bank is better than any other bank in the country, especially on the private peers. So quality of CASA, however, is on the lower side than peers. Now, we know that 811 has had a big traction, but with lower balances. So customers are generally searching for yields. HNIs do search for yields as and when the cost of deposits go up or the interest on deposits go up. They tend to switch from their saving account to term deposits. So in the overall CASA picture, Kotak has more of saving account than current account. So current account is sticky given the fact that these businesses do have regular business with the bank, so they tend to remain stickier than the saving deposits even in a rising interest rate scenario. So that movement actually can hurt Kotak Bank. Last quarter also we saw the CASA ratio declining to 53.5% from the 55-56% that they had in Q3. So incrementally, going from here, the cost of funds could rise faster for Kotak Mahindra Bank than its peers, as the customers would switch out to term deposits, or they would have to raise more money to meet their overall CD ratio or credit deposit ratio. Now, mind you, amongst the top four banks, Kotak Mahindra Bank has a CD ratio or credit deposit ratio of more than 90%. So to meet the incremental loan growth which is happening at a rapid pace in the industry, they would also need liabilities coming in to meet the outgo in terms of loan growth. So they would need strong deposit flow, and in a rising interest rate scenario, you tend to have more of term deposits. So going ahead, the cost of funds can hurt Kotak Mahindra Bank.
Okay, all right, Abhishek, got that. It's a fair point, worth keeping in mind. But today, of course, the stock is reacting well to those technical factors because of the expected increase in weight on the MSCI indices. Thank you very much, Abhishek, for joining in with the fundamentals. We will take a break on that note. On the other side, we'll discuss everything that's buzzing in the commodity space. Manisha Gupta will join in.
Welcome back. You're still tuned into Trading Hour. It is an 80-point gain that we are seeing on the Nifty right now at that 17,700 mark. So holding up very well. It is the banks which are really sort of leading to this big up move today with a near 500-point move. But let's see what's going on in the world of commodities. Manisha joins us to discuss the metal space. And Manisha, it's not looking quite as up in the metal space.
Yeah, it is not. Within the base metals, we've seen copper prices continue to trade in the positive. Can't say the same about the other base metal prices, where aluminum, zinc, lead, everything is trading in the negative. It is more about the ferrous metals like steel and iron ore. These definitely have continued to extend decline. So when you look at the steel prices, we're trading at a 7-week lows. 2% of a decline over the week, and we are down 9% on a monthly basis as well. The Chinese data has come in on the weaker side. So manufacturing, factory activity, ISM, services numbers, all of that for the month of March has been less than what the street was anticipating. Apart from that, it is the peak construction season in China. And even with that going on, the demand on ground hasn't really picked up, and that's weighing on to the markets. Add to that the fact that the US dollar index also has firmed up in the market today. That's weighing on as well. The China steel output for a third straight year in China is going to be cut, and this year to the tune of 2.5% is what the data suggests. And that has led to decline in the iron ore prices also, which are now trading at a 3-month lows. Here as well, we have seen prices decline 3% on week and down by nearly 10% on a month-on-month basis. Markets are looking at further decline for this month as well, as there is enough inventories now getting accumulated at the port. And on the demand, on ground, the premiums actually have turned into a discount because there are no buyers there, and that is expected to weigh on to the prices.
Manisha, thank you very much for that. By the way, a sharp decline coming through in IT names. Pull up the Nifty IT index. When we started the show at 11 a.m., the Nifty IT index was down about 0.25%, but now it's extended the fall to a near 1% loss. TCS down over 1%. Infosys, Wipro, HCL Tech 2 has moved to the low point of the day. There you can see the sharp sell-off ahead of numbers starting tomorrow. Here's what we'll do. We'll slip into a break. We'll come back with more on the market. Stay tuned.
Welcome back. You're with us on Trading Hour. Let's get back to the market, which has been holding up in fine form, about 0.5% up on the Nifty, and banks are doing really, really well. We have Mitesh with us for a quick update on this. Mitesh, good to talk to you. I was on a bit of a break, but now back. So you tell us, markets have moved up in the last 3 trading sessions that I was away. Nice 700-point up move. But looking at today's action, do you have a trade on the index, Nifty or Bank Nifty?
Good morning. Actually, we've been advocating some long positions for the last few days. Today, I mentioned, when the markets were around 17,700, 2030 levels to take profits. There are a couple of reasons. While the overall trend and the bias is on the positive side, last 7 days has seen us gain about 800 plus points. And also is the fact that 17,750, 780 zones is where the market had made a swing high in the first week of March, which is on the 8th of March. So broadly, I think, hitting a previous high, having seen a good rally and the intraday charts are being overbought, I think good time to at least take, if not full, at least half profits and trail your stop losses to about 17,600 odd levels. But the trading is still on the long side. I believe that while the IT index is quiet today, the Bank Nifty and the other Nifty heavyweights are showing a lot of positive traction. And therefore, the up move should eventually play out. But on the index per se, since you're hitting an important level, you might want to take some profits and re-enter on declines.
Okay, and Mitesh, any individual trades that you would like to recommend at this point?
Morning, Pavitra. I have 2 buy calls right now. ICICI Bank is something, which after a few days of pullback is coming nicely into the buy mode. So I would recommend a buy here with a stop just below levels of 870 for targets around 910. And the other one which I like is HDFC Limited. That's also, you can combine that with the HDFC Bank as well. So HDFC Limited is a buy with a stop just below levels of 2720 for targets of 2780.
Any thoughts on what we're seeing in IT names? Are any of them opening up a short opportunity? Any shorting candidates because of the sudden sell-off that we're seeing?
See, IT names, I think, there is some profit booking happening. I'm not sure I want to take a short trade right now, given the fact that the overall chart pattern isn't very negative. But, a stock like Infosys, which failed to clear the first hurdle of 1434, I think that, if it starts going towards 1380, 1375, which was the previous swing run, breaks below it, then maybe consider a short over there. But otherwise, it looks like that the IT will underperform and broadly be sideways in a market which will be positively biased. So not aggressive shorting, but if you have been trading with all long bias, then maybe taking minor short in IT could be advisable. Per se, I think, it may not be a very rewarding trade, but just to protect against any kind of sudden fall in the markets, a short in IT can be a relative short.
Okay, so short in IT for those who are looking to play the downside as well. Got that, Mitesh. Thanks very much for joining in. We'll connect with you again later in the day. Right now, we will take a quick break. On the other side, we have Jyotivardhan Jaipuria of Valentis Advisors joining in. We'll talk fundamentals on the market.
Welcome back. Let's talk about markets. Jyotivardhan Jaipuria, founder, MD at Valentis Advisors, is now with us on the show. Jyoti, you've been cautious in the markets for the last 1 to 2 years now. But do you think the tide is turning now? There are reasons to be optimistic from here on. And can equity markets give returns? Because up until now, whenever we got a guest on board, he indicated that in 2023, do not expect much by way of stock market returns. Do you think that will change? And this could actually turn out to be a good year in terms of returns?
Yes, Reba. So like you said, we've been very cautious last 18 months. But, there's some positives which are emerging now. So the first is interest rates. So as you know, last 12, 18 months was all about interest rate hikes. We've seen RBI pause. It was like probably the first major central bank to pause. We'll probably see a lot of the other US Fed and probably the European banks also pause somewhere over the course of this year. I expect Fed to pause, probably in the May meeting. So that I think could help, better equity returns. There is, of course, one of the concerns about a slowdown, which will be plaguing equity markets this year. But I think, like if we look at the next 12, 18 months, I think we'll get a positive return. We probably could end up with like a double-digit positive return next 2 years, next 18 months or something.
Jyotivardhan, hi. Good morning. This is Surabhi here. So I think, people are trying to sort of place their bets looking at the elements that lie ahead. There seems to be a consensus trade that IT is not going to really make you money this year. Stick with banks is what one constantly hears on the street. How are you cutting it up? And in the midst of all this is the consumption piece, because there's the monsoon and the El Nino sort of joker in the pack. So just tell us your approach as you're looking at the first half of this new fiscal.
Yeah, so Surabhi, we had like two simple themes for the last 1 year, and we still stick to that. One was buy domestic plays and avoid the global plays. So, IT was something we've been negative on through the last 1 year. Second is we've been more preferring the Indian investment theme rather than the Indian consumption theme, because the consumption is still expensive and, consumption on the margin is slowing down. So, we continue to stick to both these themes. So now, it's not as easy a trade as it was a year ago because, as we know, IT is underperformed quite a bit. The reason we still continue to stick to this is, there's still a lot of uncertainty about the future outlook of the IT companies. As you know, there's been a lot of layoffs in the banking space, in the tech space in US, and that I think will cloud the earnings outlook for the companies here also. The guidance will be tough. I don't think companies have enough visibility to give a guidance. So at the moment, we are sticking to, being underweight these names, though, just the stock performance makes us a bit more cautious and looking at them closely for any sign of turn.
Okay, got that. Thanks for joining us. What are your thoughts on the entire real estate space? We're getting the pre-quarterly updates coming through, looking extremely good, across the board. Is this a space that you think is good to get into now? Especially with interest rates also coming down?
Yeah, so Pavitra, there are two ways you can play it, right? You can play it through the real estate companies themselves, or you can play it through what I call the ancillary to the real estate, the tile companies, the wire cable companies. So we prefer playing it through the, ancillary space rather than the real estate companies directly, because, a lot of the real estate companies have high debt, and that's something which we are always very cautious of. So we think, playing it through the ancillary space is better. The other headwind or other tailwind which is helping the ancillary space is that the raw material prices are coming down. So if you think of tiles, gas is the raw material, the prices are coming down. If you think wire and cables, a lot of the metals prices are coming down. So they are benefiting from two things. One is they are benefiting from a strong real estate growth, which helps their demand outlook. The second is they are benefiting from the fact that their margins last year got squeezed because of huge commodity price increases. That is reversing. So we'll see margins normalize, we'll see margins going up again, and that will help also the ancillary companies. So we think those are better plays than really the real estate companies directly.
Earlier today, Jyoti, we had Motilal Oswal telling us how they've gone ahead and raised the consumption they've raised the overweight on their consumption basket by 200 to 300 basis points. And they're saying that even if there is an El Nino, even if there is deficient monsoon comes out to be 94%, it's not such a big deal in terms of the impact that it's going to have on consumption per se, because we've had a couple of good monsoons. The reservoir levels are pretty comfortable. So they're not too worried on consumption. In fact, they've gone ahead and upped their weightage. Where I know you said that, on consumption, you're not very confident right now. You're a bit cautious. But can you, throw the converse argument to what Motilal Oswal had to tell us?
So, for us, it's not so much the El Nino, because obviously El Nino puts a bit of question mark on the monsoon. But, we've had many periods where with the El Nino, the, agriculture output has been good, and the converse also is true with, where we had La Nina and we still had a very poor agriculture output. What, for us is we are always weighing the evaluations. And for us, at these valuations, it still is probably not attractive. We don't find too many attractive plays in the consumption space. So, what we like is, like I, was telling Pavitra, we like some of these ancillary to housing companies, let's say the tile companies, the wire cable companies, which are also consumption plays in some sense, and those are stocks which look attractive. But I guess when you're talking of, consumption, you're talking of, the traditional FMCG companies, those still look very, very expensive to us for the growth that they are delivering. What we'll have, like, you go back to 2003 to 2008, we had a lot of the infrastructure type, capital good type of companies do well because, they were coming off a very low base. Same thing here, you're coming off a very low base on earnings for a lot of these investment-led companies. And so, you can see earnings growing much faster than the consumption names for them. So, and they are much cheaper on valuation. So that's the reason we are more focused on actually CapEx rather than on the consumption space.
Okay, you led me to my next question, Jyoti. Actually, I was just coming to CapEx. Reading a report, quite interesting, that actually road ordering has been lower this year. NHAI hasn't been able to complete all its ordering, and there should be some spillover in the first half of the new fiscal, apparently. But then ordering, we know, defense, for instance, railways, has just been really blowing through the roof, right? So how exactly are you playing CapEx? Through what sort of companies?
Yeah, so, so if you just think about it, what the government has done is CapEx as a percentage of GDP spend is going up constantly from the government. Conversely, the non-CapEx, which is the consumption part, is going down. So ultimately, we are focused on stuff which is relying on government CapEx to really do well. At the same time, there's some fleeting signs that even the private sector CapEx are going to come in. So we are playing it two, three ways. One is we are playing it through a lot of these pipes and companies which benefit from this Har Nal Jal program of the government. The other is we are playing it through capital good names, which is like really people who are benefiting from the first leg of CapEx happening. Some of them is going to defense, some of them is going to railways, some of that could be going to general industry. The thing which we are avoiding is like a lot of these road names. We don't like generally all these EPC contractors because they supply directly to government. Their working capital normally is very stretched, and so the balance sheets get messed up quite a bit. So that is the part which we avoid. We prefer playing capital goods and ancillary companies there.
All right, got that. Just one final question. What is the kind of overall earnings growth you're factoring in for Q4, since we're just getting into the season this week?
So Pavitra, Q4, I'm looking at Nifty earnings growth being close to 15%. But what I must warn you is a lot of this is skewed by banks on one side. Banks account for a lot of the growth. And obviously on the negative side also, they're getting dragged down quite a bit by the global commodities. So there's quite a bit of skew. Otherwise, some of these other things are doing well.
Very, very quickly, is defense still attractive in your local theme? Because stocks have run up. So are the valuations still comfortable?
So, Reema, like pure defense companies, I think they will pause in terms of share price performance, at least because we have a lot of order book and the stocks ran up along with the order book. We now need to see the execution. But what that is also leading to is there's a second rung of companies which supply some components to these people who are now, who have not run up as much and they are much cheaper. So those are the things which we are looking at. So I would say ancillary to defense also.
Got it.
All right. Great talking to you, Jyoti. Thank you very much for joining in, and we look forward to our next call. Thank you. The market, by the way, has cooled off a little bit, one would have to say. The banks actually are adding more momentum. It's a very interesting story that's playing out. Banks are pushing even higher and IT is pushing even lower. Just a case, and that's the Bank Nifty. Case in point, pull up stocks like HCL Tech, Wipro. Let's pull up the intraday graphs, Tech Mahindra. That Nifty IT chart is the big spoil sport, really. And a lot of these IT names are under pressure. So are some consumer names. For instance, from the highs of the morning, ITC has given up a little bit of gain. Tata Consumer is in the negative. So these are some of the stocks that have moved towards the downside in the last half hour. So Nifty shaved off a little bit, but then banks are providing plenty of support and momentum for now. We'll be taking a break, but before we get to the break, I think we have some news at the bottom of our screen. Okay, so this is L&T Tech getting into that settlement with the Department of Justice. They're paying about 81 odd crores to get into the settlement.
Came, early in the morning, where basically the US Department of Justice said that L&T Technology staffed some people in the US on their B1 visa, which is cheaper compared to the H1B visa. They should have done it on the H1B visa. And, so on account of that, L&T Technology paid less in terms of the overall visa fees, right? Because you staffed them on B1 instead of H1B. So they completely settled the issue because this case was ongoing for the last 3 years. And they have to settle it for about $10 million, roughly 81 crore rupees. Now the statement has come in from L&T Technology, and the key point over here is there is no impact on our financials. The street was worried that this $10 million payout is approximately 7 to 8% of their PAT estimates of this year. If the company is going to be making that provision, it's going to slash your EPS estimate. That was the worry on the street.
But they're saying they've already provided for it earlier.
Exactly. So now the clarification is coming from the company that there is no impact on our financials due to the settlement. As per accounting principles, we have provided for this amount over the past quarters, and therefore the quarterly and annual financials, which will be released later this month, will not be impacted. So in fact, the clarification from the company is positive. They have settled. There is a $10 million payout, but it has already been provided by the company. So Q4 not impacted.
All right, Q4 not impacted. That is on L&T Tech. But with that, we are going to get into a short break now. When we come back, we will be talking all about the new changes by SEBI that has been announced for AIF. So stay tuned for that. Welcome back. You're still tuned into Trading Hour, and let's talk about another important story that came through this morning. This one is on SEBI ordering AIFs to offer direct plans. They've also, in fact, put in place a new model which is for commission. So Sonal is here to round up all of that news for us. Sonal?
Thank you so much for that. Yes, it's an important update after the consultation paper that SEBI floated in the month of February. Now in a circular, they've gone ahead and said that yes, now AIFs will have to give an option of direct plan to the investors, which would involve no distribution fee or placement fee to any investors. So that is on the direct plan side. This option has to be given to investors by the AIFs in order for them to invest here as well. Now, AIFs that invest in AIF investments which are made via a SEBI registered intermediary will be onboarded via a direct plan only as per the circular. Now, this is on the direct plan. The second change that they've made here is in terms of the commission that is paid as well. In terms of this, category 3 AIFs, which is the third category, will charge fee on equal trail basis to investors, and there will be no upfront distribution fee here. For categories 1 and 2, there will be only 1/3 of distribution fees which will be paid upfront, and the rest can be paid on trail basis. So this is the news and applicable from 1st May as well. Now, why have they made this change? This is in order to ensure that there is no mis-selling and double charging of fees to investors in the current regime. As per the current fee structure, investors looking to invest in AIFs, they are prone to double charging of fees. One is, of course, via the investment fee by the investment advisor, and second is through AIF distribution fees. So in some cases, this could actually contribute around 5% of the total investments itself and become a big chunk. With this change that has come about, this would be done away with, as the distribution fee will not have to be paid by the investors via direct plan. Now, as I said, it was back in February when SEBI had come out with this consultation paper, and this is the reason why this change has come about. Now, just to give you a perspective, upfront fee is where it is paid to the broker in the same month as purchase of the fund, while trail commission is paid every year until investment is withdrawn. So now it will be done over years. So that will, of course, give some support to the investor as well.
All right, Sonal, thanks very much for explaining all the new regulations to us, and they come in effect from May this year. The only thing that hasn't happened, Pavitra, like mutual funds, is that at least SEBI has not yet said exactly how much commission can you pay out, which is very strictly regulated and mandated in mutual funds at least. Well, let's take this conversation forward. We have two guests joining in, and they are from the industry. Nishant Agrawal, Senior Managing Partner and Head of Investment Advisory at ASK Private Wealth, as well as Anshu Kapoor, President and Head Private Equity at Nuvama Asset Management. Gentlemen, thank you very much for joining in. So we have someone representing the asset manager, the product manufacturer here, as well as someone who's representing, of course, the interests of the end client or the end investor. So let me start with you, Anshu. Does this, first of all, create any kind of, fear in the minds of the AIF world that there could be a lot of regulation here? As I said, they've not yet, they've stopped short from saying how much commission can you charge, but they're saying direct plans have to come in, commission at least in some category of funds has to move to a trail model. Your first thoughts?
Hi, Surabhi. Yes, I think our view is that any regulation that is good for the investor is good for the industry. So I think we welcome these changes. The regulation, the framework is progressive and proactive. It does provide for transparency, and transparency in any industry is great. It also allows product selection choice to be made purely on merit and not on distribution fee. So that's a welcome step. And finally, it does recognize the fact that there are some categories in the AIF category which may need a little bit more flexibility to pay out a little bit higher upfront to progress or spur the growth of the category. So I think these are all welcome changes. We wholeheartedly support these, and we'll go into more details as to where there could have been a little bit more from an industry point of view, but overall very, very positive.
Okay, Anshu, just to follow up, I mean, that's a good, I think, in principle opening statement that you're making. You're in agreement with the way the regulations have come about. But help us get into the granularity, again, from the perspective of someone who's managing an alternate investment fund. Where does this start to pinch? Because in category 3 funds now, you can't give any upfront commissions at all. So will it sort of pinch the growth of the category? And again, even category 1, category 2, you can only give upfront up to 1/3, 33%.
Right. Yeah, so we can go into detail, Surabhi. So as far as category 3 is concerned, the regulator is very clearly saying that there should be no kind of differentiation in similar kind of products. The choice of vehicle should be independent or should be purely based on merit. What it means is that if you're buying a long-only product, if you buy it in a AIF category 3, or you buy in mutual fund or in a PMS, the distribution fee should have the same logic, and which is a welcome move, which kind of makes sure that the clients are offered products purely on performance. So a lot of long-only products that were offered on category 3, if they will do well, is when the distributor will pick them up now. So it kind of levels the playing field across vehicles for long-only products. There's a small category of products which are hedge funds or long short, which are also clubbed into that, but that's anyways are differentiated products. So from that point of view, it is a great thing. As far as category 1 and 2 is concerned, there is some more flexibility given by the regulator on structuring the distribution fee, which states that a little bit higher upfront can be paid. It's a welcome move. The fact that these are all largely 7 to 10 year products, closed-ended, are asset classes like private equity, venture debt, private credit, real estate and all, which are anyways hard for investors to access or inaccessible, and are a little bit more complex to explain from a sales point of view. So therefore, it's a welcome move. The regulator does recognize the fact that this category needs some help to spur the growth. It's a more involved sales process. My personal view would have been that a lot more structuring, flexibility in structuring would help this category. It's a very small category per se. All 3 categories put together.
Okay, seems like we have some trouble with that. We are going to try to reconnect. But in the meantime, Nishant, let me get you in also on this for, the other perspective as well. SEBI had first announced this on PMS, so a lot of the distribution efforts moved to AIFs. Now, with this coming into AIFs, tell us from a private wealth player perspective, how much of a negative is this? Because, of course, anyone who is big in the private wealth space will be affected, right? Since it is affecting your commission so directly.
Sure. So I would say private wealth offers services to clients on 2 platforms. One is the distribution or MFD platform, and second is an investment advisory platform. I think this is a very, very positive news for investment advisory business or investment advisory platform, because for a long time, AIF was the only category left where there was no direct plan available to clients who were paying fees to their wealth advisor or wealth manager. Earlier, it was mutual funds followed by PMS. And only AIFs were left which only had regular plan. And like you mentioned, investor was paying double fees. First the full fees on the plan and then the advisory fee to the advisor. Now with an option of direct plan being available, there will be a resurgence of a lot of investors coming towards investment advisor and all product being available on direct plan. So the platform has been neutralized. That's the differentiation which has gone for investor, and it's a very, very good change. I would say even for the distribution platform, the impact may not be as big as it is thought. A lot of this was already being planned by asking for trail commission even when upfront was available. So to service the client over a long period of product, 5 years, 6 years, 7 years, you need to be involved in the product. And us and many other players in the market were anyways preferring a part upfront and part distribution commission when we were offering AIF to investors. So this is in line with that. Lastly, on category 3 AIF, in the medium to long term, it might turn out to be better for wealth manager, because please understand the upfront commission was only paid on commitment amount which the investor commits to an AIF, let's say category 3. However, when the trail commission comes in play, you get the trail commission based on the NAV of the product or market value of the product. Typically, if we expect a 15% growth in a long-only equity product every year, then the value of the investment grows from 100 to almost 150 over a 3-year period. So your trail also gets increased, like customer expenses increases on commitment on market value. Similarly, the trail goes up. So it's a short-term negative impact on the part of the fees, but a very, very welcome and positive change for investor and the category over medium to long term.
Okay, got that. Stay on, Nishant. We have more questions for you. We'll get into a very quick break and continue this conversation on the other side. Welcome back. You're with us on Trading Hour, and we are discussing the impact of SEBI's latest recommendations for AIFs, or alternate investment funds. These new regulations kick in from May this year. Nishant, to get back to the conversation, help us with the numbers and the data, because the industry is really opaque and we don't have sort of, quarterly or monthly listings. What would be the total size across category 1, category 2 and category 3? Which category is the biggest? And are there a lot of people coming through the direct channel at all? Isn't it all or most of it distributor-led or maybe advisor-led? And again, what's the breakup between pure advisory and distribution?
Sure. So basically, between category 1, 2 and 3 put together, the industry is around 7 lakh odd crores. But the industry can be broken into 3 buckets. One is all the institutions, the insurance company, the banks, the global funds, which comes directly through fund managers' contact, and there is no distributor or domestic advisor which is involved. So that's a category which will get affected, because currently they pay only the one fee plan which is available in all these AIFs. And now when the direct plan are there, the AIF manager might be required to offer the direct plan to these institutions which come directly to these advisors. We have to see how that evolves. The second category is the HNIs and domestic investors. There are 2, I would say, categories by which the investor come in. One through an intermediary and one directly to the fund manager. The intermediary business is driven between distribution and investment advisor. And I would say currently more than 90% of the business is under distribution fee-led business. Only 10% is investment advisory, very, very broadly speaking, because there was a kind of, I would say, differentiated fee structure and there was a double fee. The AIF was not moving clearly into investment advisory. So 3 categories. Institution business will impact the earning for fund managers, because those institutions will now ask for direct plan. And under the non-institutional business, it will be a mix of distribution and advisory. And it will be more of advisors who will be recommending direct plan instead of distribution plan going forward.
All right, got that. Just a little bit more of a zoomed out question on what we could see in the next few days. Anshu, coming to you now, do you think up until May 1st, when this, actually comes into play and you do have to follow these new rules, do you think we're likely to see a big rush into this category just on account of, a lot of these private wealth players pushing the AIF harder?
Well, it's unlikely. These are very involved sales process products. So it's unlikely that suddenly we'll see a big rush. I think overall this category is still very, very small. There's a lot that needs to be done for awareness, information and education. And anyways, total number of investors are very small per se. So it is not a widely distributed product. So I don't think there'll be a flurry of activity over the next 20 days.
Gentlemen, before we wrap up, I come to the point from where I began. Right now, there is absolutely no talk of regulating commissions in terms of how much money can be paid out. That's an entirely market-driven, industry-driven process. So leave us with some thoughts, Anshu. What are ballpark commissions like, and will this move result in commissions coming down at all, commissions going up? What happens?
So maybe I can answer this in two parts. Surbhi, if it's okay, I don't know because I got dropped off. I actually wanted to make a point on the direct plan first. The point is that today AIFs cannot be marketed or promoted extensively. And therefore, my view or suggestion to the regulator is that if we are introducing a direct plan, and it's a step in the right direction, also help us create tools for investors to find, analyze, and evaluate these products. I think that will help the industry per se. Coming to your question on the point of whether the total payouts and all will increase or decrease, I don't think much will change. It's just that the total economics will remain largely the same. So let's say if it's a 5 to 7 year product and the total fee pool, management fee is 8%, and if about half is being shared with the distributor, the payout terms will remain the same. As in, let's say if half is paid, for 4% is shared with the distributor, now it's being shared within the trail model or as per the category. So my view is that not much will change from a total economics point of view. But I think overall confidence of the customer will grow, and therefore overall revenue pool for this asset class will increase.
Okay, all right, got that. Gentlemen, thank you very much for making sense of these new regulations for us. And of course, we'll touch base with you again once they're rolled out and see how industry and investors are adapting to the new normal. Thank you for joining in. Well, Pavitra, with that, I guess it's time for us to leave as well.
Let's do that. We're going to wind down. The market has come off a little bit, I have to say, and that's largely on account of what's happening with big tech, right, ahead of the earnings season starting. But that's all on this edition of Trading Hour. You guys stay tuned. Halftime report up next.